Welcome to the deep dive.
Yeah.
So you've probably been there, right? Navigating those huge aisles at Costco, giant cart, maybe leaving with way more than you planned.
Oh, yeah. The classic Costco run.
Exactly. That whole treasure hunt feel. It's definitely not your average grocery store trip. And today, we're actually diving into something just as interesting. Costco Wholesale Corporation. The stock, ticker Coast A on the NASDAQ Q.
Yeah. And what's fascinating really is how their whole business model works. It kind of flips the script on traditional retail.
How so?
Well, that membership fee, it's not just some add-on. It's a core part of their profit, a really stable recurring revenue stream.
Right.
And that income basically allows them to keep prices incredibly low. They try to cap markups at just 15%.
15%? That's wow.
Yeah.
Compared to what, like 25, maybe 50% elsewhere?
Exactly. Traditional supermarkets often run much higher markups, and Costco isn't small potatoes either. They're global. Around 890 warehouses now, and they're actually the third biggest retailer in the U.S. by annual sale. Well, as of earlier this year, March 2025.
Okay, so that low markup strategy clearly isn't hurting them. So our mission for this deep dive then is to figure out how they pull this off. We'll look at their finances over the past decade or so.
Yep. Check out their competitors' strengths, what makes them different.
We'll glance at the stock charts, see what they might be telling us, and apply some value investing ideas to see if the stock price makes sense right now.
And finally, weigh up the pros and cons for you if you're thinking about owning costs.
Sounds like a plan. So where do we start? Maybe the financials.
Sure. Looking back, the growth is really consistent. Almost relentless, you could say. Net sales, they've more than doubled since 2015.
Doubled from what?
Went from about $113 billion up to nearly $250 billion in fiscal 24.
Whoa.
But here's the kicker. Like we said, those membership fees, they've also almost doubled in that time, from around $2.5 billion to nearly $5 billion.
So that's the really stable part of the income.
Precisely.
Yeah.
It's sticky revenue, very predictable, and it funds those low prices. Plus, their global membership renewal rate, it was 90% last fiscal year.
90%.
Yeah.
That's incredible loyalty, especially for something you pay for annually.
It really is.
And it's not just sales, right? Their actual profit, net income, has climbed significantly too.
Oh, absolutely. It's gone from about $2.4 billion up to over $7.3 billion in fiscal 24.
Okay, how do they keep costs down to achieve that profit on such low markups?
Well, it's all about efficiency, relentless focus. They source directly, keep the warehouses pretty basic, no frills.
Right, the concrete floors and stacked pallets.
Exactly. And they limit the number of products, the SKUs, only about 4,000 items. Way less choice than a typical supermarket, but it streamlines everything.
Fewer items means bigger orders, more efficiency. Makes sense.
Plus, they treat their employees well, relatively speaking. Lower turnover than much of retail, which also saves money in the long run.
And I read something fascinating. They don't advertise, at all.
Pretty much, yeah. No traditional ad budget, word of mouth, the store experience itself, that's their marketing. It's quite counterintuitive, but clearly effective.
Okay, so strong operations, loyal customers. How does this translate for investors? What do the charts say?
Well, looking at the stock price over the last, say, 10 years, it's been a strong performer. Consistent upward trend, good volume. As of August 2025, the price was hovering around 953 lirs.
Near its highs then.
Yeah, near the 52-week high. So clearly there's a lot of investor confidence baked in. But this is where it gets interesting if you look at it through a value investing lens.
Like Benjamin Graham style. Buying cheap.
Exactly. Graham's whole philosophy is about buying good companies for less than they're intrinsically worth, finding that margin of safety.
Right.
Now, Costco, it definitely has strong fundamentals. Consistent earnings growth, great dividend record. They've raised it 21 years straight, plus 5 special dividends in the last 13 years.
That's impressive shareholder return.
It is. But that current valuation, the trailing PE ratio is sitting around 52.8.
53 times earnings. That sounds high.
It is quite elevated, yeah. It suggests the market expects a lot of future growth and is paying a premium for that stability and quality right now.
So from that strict Graham perspective, even though it's a great company, it might be considered overvalued.
Likely, yes. The margin of safety, that cushion against things going wrong, it looks pretty thin at this price point.
Okay, so summing it up for someone listening, what are the core arguments?
Well, the pros are pretty clear. Super stable revenue from memberships, that incredible customer loyalty we talked about, consistent returns to shareholders, amazing operational efficiency, and they're still expanding globally and online.
And the cons.
Mainly that high valuation, you're paying a steep price for those positives. And, while they face controversies over the years, supply chain stuff, some legal disputes, nothing seems to have fundamentally derailed them long term. Their core business is just very resilient.
Right. So, to wrap up, Costco is undeniably a retail powerhouse. Unique model, strong finances, loyal customers, super efficient even without advertising.
Strong fundamentals, solid returns historically. But, as we said, that current price tag seems high if you're a strict value investor.
Okay, so here's something to think about. If a company with Costco's obvious quality, its dedicated customer base, and this really unique competitive advantage, its moat, is trading at such a premium, what does that tell you about how the market feels about stable, value-driven businesses in the long run? And maybe more importantly, how does that fit into your own investment thinking?